from FIG Securities. Jim, a lot of action. We've been saying this all morning, overnight. What went wrong to unsettle investors? Because it's not as if we didn't know, at least for the last 6 months, that there was a massive amount of printing going on, care of the Federal Reserve. Why did we just? It was like Rip Van Winkle land.
Yeah, look, it's interesting. We've been focusing on this for a long time. Well, in our discussions, certainly, and what we're seeing is this supply starting to really impact the market. It's like any market, you know, when you know someone has to sell something, you're less inclined to be aggressive on the bid side. But what's happening is we're seeing this steepening yield curve, and what it means is that longer dated assets are, you know, offering very attractive yields in relation to shorter dated assets. So much so that given that any other offerings over and above that curve are offering very competitive yields, and of course that does compete with other markets like equity markets.
What point does it become a Dutch auction? Because this is a global funding drive at the moment. How does the United States remain an attractive destination for the buyers?
Look, that's the ultimate question, but that is, as you say, it's a function of price. It will find its equilibrium, and it's a little bit concerning. I think this movement in the yield curve is something that needs to be watched very closely. If you take, for example, what's happened in Australia, we've got a steepness in the curve from, say, the cash rate to the 10-year government bond rate, which is a risk-free rate in this country, of approximately 2.4%.
Well, maybe we should look at that. I think we can bring that one up as you're actually talking about it, the yield curve chart.
The last time that we saw levels this ilk was around 15 years ago. But the actual peak that we saw 15 years ago was closer to 5%, that differential. So if you overlay that in the current interest rate environment, then there's a lot of room for longer term rates to move up. And given the amount of supply that we have coming in the pipeline, not only in the government but the state government sector, then, you know, I think that investors can afford to be a little bit standoffish.
What point does that then push out payback projections? At what point do you need to do a revision on this, because it all just gets too expensive?
Well, that's right. I think the problem is that as rates go up, it becomes a budgetary issue, and the thing is that there's not a lot of control on that part of the curve. It's a bit like holding a garden hose too close to the, you know, too far down from the nozzle. So, you know, I think that there are some ways that we can sort of control supply in this country by changing the types of products that we offer and opening up other markets. I think it's really important. It's fundamental to keeping those costs down. But it's interesting because as those longer rates move up, everything over and above, or all the lower credits, of course, will move up as well. And what that does is, you know, it's providing double-digit returns for very highly rated companies, and they're very competitive returns, historically speaking, for, you know, against equities. So it's interesting.
But what does it do for mum and dad consumer out there with a mortgage?
Well, I think they're fairly comfortable at the moment. I mean, I think at the end of the day, the mortgage rate at around 6%, you know, you can go and draw it down and invest in zero risk bonds, semi-government bonds at over 6%. So it's actually, they're not affected because they're in the floating rate side of things, and that's very well controlled. But, you know, this does impact on longer term cost of funds on the country, no question.
Where are you sort of seeing, though, if anything, things heading? Where do we reach an end point? Where does it settle down?
I wish I had an answer to that. I think, you know, ultimately it's the debt markets need to reopen fully. We're seeing some encouraging signs. Again, we saw convergence in that corporate spread to the governments. I think we're seeing companies like Westfield coming to the US market issuing bonds. We saw a major bank issue this week in Australia at you know, competitive levels in large volume, unguaranteed. That's a good sign.
But are we seeing bank-to-bank lending? We might have seen a narrowing of the LIBOR spread, but interestingly enough, if you actually look out at the highest and lowest interest rates that banks are charging each other, there has been a widening in that, actually, according to the British Bankers Association data. So, I mean, that data gets fed into LIBOR. I mean, it's all very well to look at LIBOR in isolation, but people are saying you've got to add into that, you know, the amount that individual banks are actually contributing, and there's a wide spread.
I mean, it's interesting. These benchmarks seem to have a life of their own. I mean, they're obviously determined from contributors, but the reality is that for things like deposits and short-term NCDs, things like this, the rates that the banks are offering are far in excess of those rates.
Are you believing now that the stock market is sort of a leading indicator on the bonds, or the bonds still have all the cards and are really pointing the way?
Well, I think the bond market is a great leading indicator. The shape of the yield curve is really the collective market wisdom. And in theory, you're looking at a normal yield curve that spells a recovery. But I do think that there are these massive issues of supply that are overhanging that are distorting that to a certain extent. And I think that it has the potential to become problematic. But naturally, a normal yield curve does mean a recovery is in place. And when you think about the inverse yield curve that we led into the downturn with, it was a preemptive indicator. So that side of it's encouraging.
Worst case scenario?
Well, I think we're starting to see a few cracks in the sovereign debt market, where we're seeing downgrades and we're seeing tenders failing. I think that's something that is a cause for concern, because if we do see pops in these longer dated yields, that does impact the equity markets.
But as far as Australia goes, no real comparative concerns as yet.
Yeah, I would say so.
Jim, many thanks. We'll see you next week.
Thanks, Carson.
Jim Stening from FIG.